let's look at electronic business systems. A good way to start is to ask the question, what's an internet? Internet is an architecture, it's a canvas to connect hardware. So then what's cloud? Cloud refers to the software and services run on the internet. So if you visualize the internet as an architecture in this visual, the dots are like the hardware, and then the arrows and the links are the connections, and they are the wide area networks, local area networks, and so forth. They're the network connection connecting the hardware or the computers. If you ask the question, what's electronic business? It's about the application of electronic networks, including the internet that we were talking about, to exchange information and link business processes among enterprises and individuals. So the e-business has assisted in connecting business to business and also business to customers in digital communication. Electronic data interchange is where the data is being interchanged between business to business. There are standards and protocols that has to be followed in exchanging this data. There are three advantages in electronic data interchanges. First is that it eliminates data entry errors, because once it is entered into the system, it is there and it's been interchanged elsewhere. It increases efficiency because only once one got to enter that into the system and is saving on duplicated labor costs. It also increases the speed, because when data is being exchanged or being transmitted elsewhere, same data could be used elsewhere for decision making. A good example for this of business to business electronic data interchange are the banks, how banks communicate between banks, among banks. The EDA standard that the banks use is called SWIFT. SWIFT stands for Society of Worldwide Interbank Financial Telecommunication. So that's software that enables this data interchange and standards. So it's the software that's used to transact business or data on the internet. It could be business to business or now business to customers. If we take Amazon, for example, we can look at how Amazon does. Amazon would take the customers and take the payment receipts into the shopping cart. Now that data interchange is between Amazon, which is the business, and the customer, business to customer. Then the customer would place orders through the internet and uses a customer software provided by Amazon. Now that's called business to customer interchange. Then the Amazon will have to pay for shipping costs to suppliers, and that's a transaction or data that's been interchanged is called business to business. It uses a different software to do that. Then supplier has to be paid by Amazon. Supplier payment software it will use, and that's a business to business interaction. So these transactions, electronic data interchange transactions, can be classified into two types: business to business and business to customers. But what we find now is that business to customer transactions are increasing and business to business transactions are decreasing. The reason for that is that enterprises want to interact with the customers more directly, and therefore they use software to do that, to connect with the customers directly. So on the value chain, there are two aspects on the value chain. One is upstream and downstream. One that deals with the customer, the other that deals with the supplier. So the one aspect of the customer data interchange is now been taken over by business to customer aspect, and whereas the supply side is dominated by business to business aspect. So the business to business has now shifted to business to customer. Additional examples for this is international airline tickets. They've been sold on the internet to passengers. Airlines now hardly sell tickets to agents anymore because it's the business to business, because there's a middle person, which is the agent, that's involved, and that increases the cost to the customer and also increases the cost to the airline. Whether it is a business to business or business to customer, there is value chain management that's taking place for the enterprise. And in this value chain management, enterprise collects relevant data. It collects data about the customer. It collects data about the supplier. And that enables the enterprise to make relevant decisions. And these decisions take the form of predictions, forecasts, and preferences, and then inventory orders, and so forth. Now that we know that the accounting system has now transformed from manual to automated systems, we have to understand what transition has taken place here. In a manual accounting system, there's generalizing that takes place, and that generalizing occurs into the books of original entry, and that's been entered in a chronological order, and then from there it gets posted from the journal into the subsidiary ledgers. And then we summarize these events that's been captured through the journal entries, through trial balances and other financial statements. If you look at an automated accounting system, the same aspects are taking place, like generalizing, posting, and summarizing. But it's now occurring in an electronic platform. Most importantly, what is happening here is that event is captured and first enters into a subsidiary ledger, and then goes up, and the general ledger gets updated. For example, when a customer places an order and then a sales invoice is generated, upon the customer is being served, that sales invoice is now recorded, and then sales event data or the sales journal gets updated. Once the sales journal gets updated, the master data or the general ledger gets updated. So along with the sales data, accounts receivable gets updated simultaneously, and it is the master data that gets updated after the sales data is been updated. Whereas in the manual side of the system, on the manual accounting system, you start with the posting and then update the general ledger and gets posted to the subsidiary ledgers like sales ledgers. So it's the master data that becomes the repositories, and they become the permanent data that's maintained over extended period of time. This master data could have different fields in it, and these fields can contain relevant information that the entity requires. It could be about persons, organizations, and then about the event and what's the status of the event as well, like whether it's accounts receivable, inventory, and so forth. The master data include such data as accounts receivable master data, where it will update the accounts receivable side, and it could have customer master data. It could have a general ledger master data. So these master data repositories could have different files, which one file that relates to accounts receivable, another file that relates to customers, another file that relates to general ledger. So the master data, although it is there for time to continue, it gets updated. It gets updated in 3 ways. First is when new information comes in through related events that has occurred with the enterprise. That will bring in new data, and those data are screened by the enterprise rules, and then relevant subsidiary ledgers gets updated, and the general ledger or the master data also gets updated. The second is data gets maintained. Data gets maintained by adding data that we just talked about, and also deleting data. For example, there could be a customer that has left, and we might decide to delete those data. Or we might even replace some data because the customer's business name has changed, or the customer's address has changed. We need to update those data. The third is the standing data, which is the permanent data that keeps continuing. It's about warehouse location, selling price, credit limits, and so forth. That would continue as permanent data for some time, but it is not there to stay forever, but for a given time period, it will stay as constant. There are 3 ways to automate an accounting system and then continue with it. One is having a batch system, the other is having an online system, and the third is a real-time online system. In a batch system, the events are batched. They have been collected, aggregated, and then after a certain period, they have been processed and they have been entered into the system as a group. But a drawback of the batch system is there's a time delay in entering data. But once the data is been entered, because it's electronic system, the subsidiary ledgers get updated. If it is a sales, then the sales event data gets updated. And when the sales data gets updated, the inventory data gets updated, in relation to the sale, the inventory that's been taken for the sale, and because of that, the master inventory data also get updated, master sales data also get updated, and that transaction then leads to accounts receivable, and that accounts receivable gets updated, and then the cash also gets updated, because when cash is received, the cash register must be updated. The second way of automating is online transaction entry. It uses data entry devices to capture business event data. And through those devices, the data, event data, is entered into the information system, into the hardware directly. So you don't need data entry clerks. It automatically compares with the price list, for example, and then informs the customer. So, for example, a customer wants to place an order, the system will check whether the item is available and inform the customer it is available. If it is not available, give a possible due date that the item will come, and ask the customer whether the customer would like to place an order right now, or at least the customer comes to know that the goods will be available by this date and can make a decision. But you don't require manual labor to do that. Online transaction entry, in that prices are automatically generated by the system, and the computer retrieves the data from the system, from the master data stores. It's considered as online because the data entry device is connected to the computer. And there are many contemporary systems that are being used to capture online transaction entries. The three most popular are the barcode readers, the scanners, and the radio frequency identification readers. These technologies eliminate human errors because when these barcodes are read, the prices are read correctly, or when they are scanned, they are being read correctly, and then they automatically gets updated into the sales ledger or the purchase ledger, and then goes into the master ledger. We have this experience in buying goods from various stores like supermarkets or hardware stores. We go to the store, and then the item would have a barcode reader or a scanner or QR code, and we just come and scan that. The QR code is to scan it, and when we scan it, the the price is read on the screen, and the item details comes up, and then the payment is made, and the customer can take away the goods. But because of that event that's been recorded, the sales data get updated, and the inventory data gets updated for that event, and the sales master data gets updated, inventory master data gets updated, and the accounts receivable gets updated, and the cash ledger also gets updated, because cash is expected, and when cash is received, the cash ledger gets updated and the accounts receivable gets updated for the payment received. Online real-time processing is the third way of automating an accounting system. In this, you gather the business event data at the time of occurrence and updates the master data almost instantaneously. It provides results arising from the business event in a very short time, in almost real time. It is a complete system in all stages of the business event data processing, and occurs all the updates almost simultaneously and in a very short time span. So the ones that we were talking about, the sales, there's hardly any time gap in updating the sales data, the master sales data, the price list, if at all, the inventory for the event, and inventory master data, and the accounts receivable for that event, account receivable master data, and when cash is received, cash ledger, and the cash master data file. There are various communication networks for the online real system transactions. There are client or server technology that could be used for the electronic data interchange, or there could be local area networks where the computers are there, or the technological equipments are there, and they are connected within the given enterprise. Or wide area networks, it not only covers the enterprise, but it also covers the business partners like customers and the suppliers. Or it connects with the internet, for example, web browsers, intranet, and also extranet. There are various ways or methods of conducting electronic business. The four more popular methods of conducting electronic business. The first one is emails. Emails is a non-standardized format of conducting electronic business. But the data capture is difficult when transacting business through emails. The second is electronic data management. Is using PDFs and images and so forth. Again, using them and showing them to customers, and then asking customers to pay and so forth. Data processing is complex and difficult, but may suit certain enterprises because their products are such that they should be visually displayed and customers should see it first, and then only a transaction could occur. The third is electronic data interchange, which is very popular, and is a protocol or translation and application software that's been used. It collects data easily and often on a real-time basis. The fourth is one of the most popular way of conducting business today is internet commerce. In internet commerce, enterprises use web browsers, various software languages like HTML, XML, and data collection is easy on online real-time basis. There are various architectures for internet commerce, web services that are available. Service-oriented architecture is one of them. It refers to well-defined, independent applications that can be distributed over a network or web services. The service-oriented architecture applications are essentially plug-and-play components that are available on the internet. To plug and play, they must be well-defined, they must have well-defined processes and self-contained and independent of other processes. The service-oriented architecture browsing software example is XML applications. They can be implemented through web service documents like web service definition languages, universal descriptions, discovery, then integrations, UDDI, simple object access protocol, SOAP. So if you talk about internet commerce and electronic business, what it does is it connects the customer and the vendor through extended forms of applications. So there's internet, which is a public-based infrastructure, is the canvas there for the public to use. Then there could be a customer, and then the customer's creditworthiness and so forth, or the enterprise's creditworthiness as a customer could be checked. And these checks are done by various network providers. And it connects with it could be a physical connection or the network for this customer. And then through this network provider, the customer can connect to the internet and access the internet. And when the customer accesses the internet and the enterprise now is present in this architecture of the internet, it can now talk to various other providers like VeriSign to find out about this customer. For example, the creditworthiness of this customer, and get information to the enterprise for verification. Therefore, the enterprise doesn't have to wait too long. And then the enterprise has its own server, which connects to the internet architecture. And then that architecture, which is the network provider, is now connected to the firm. It could be accounting firm or business firm and so forth, could get connected. And there are also other vendor services that the enterprise can access through the internet architecture, because these other service providers providers are also connected to this architecture. So when there is a connection to the internet, through the internet, it can ask for the connection to various other service providers. So there are three important parties to an internet-based transaction: network provider, assurance providers, and servers. The network provider is the one that provides connection to the internet, and it allows parties to conduct business events on the internet. Assurance provider ensures that event data are reasonably secure. For example, the customer is being checked. VeriSign operates as a company for verification. It's a verification company of customers or any other enterprises. Servers, they're the customers, suppliers, enterprises. They are equipped with computers, and they have specified software and hardware that provides services to another computer. And this computer, other computer, is the enterprise's computer, and through the assurance provider, through the cloud, through the internet canvas architecture, it can now connect to the enterprise.